Good afternoon, everyone. It is 12 o'clock, so I think we will get started with today's topic for the Moses webinar series. So today we're going to be talking about negotiating land rental arrangements. And we have Dale Nordquist, an economist with the Center for Farm Financial Management, who will be leading us through that discussion today. So just as we've done in the past sessions, we certainly encourage you to ask questions along the way. And, we are a fairly small group, so when appropriate, we can unmute and ask those questions, or feel free to chat them in, and we will be watching for them. So I will turn it over to Dale and let him go through today's topic.
Well, good afternoon, everyone. Again, as Pauline said, I'm Dale Nordquist. And am I coming through loud and clear, Pauline?
You are, Dale. Yes, can hear you just fine.
All right. Well, welcome, everybody. Today, we're going to talk a little bit about, as Pauline said, land rental arrangements and negotiating land rental arrangements. Always a very challenging topic, and a topic that actually we and our folks in Extension in Minnesota get probably the most phone calls on, I think, of just about everything, especially at least in the farm management area. So it's always an important topic. We're a little out of sequence here today because of some scheduling conflicts we had with our speakers. So normally we would have liked to have talked about our FinBin database, which I think that's next week. So I don't think we've talked about that yet, but I'm going to be using some of the data from our FinBin database to talk a little bit about land rental arrangements here this morning. So next week when you come back, and I hope you do, because FinBin is a really, really useful tool, I think, for everybody in farm management. Some of it's the largest farm business management, farm financial management database for farmers probably in the world. So, and one of the best. So it's a great tool that you want to hear about. And it's got some of the only actual organic farm financial information in it from actual farms that's out there. So it's a great tool for you guys to use, I think. So in terms of negotiating rental rates, I always think there's always two rental rates out there. When you start talking about negotiating a price of land, there's the market rental rate and there's the fair rental rate. And those two are definitely not always the same. And it's really been true in the last several years. If you were going to try to negotiate on a fair rental rate to the renter in the last several years, you would have never been able to rent a piece of land. It would have been very odd because the returns to farmland were so low for several years there for conventional agriculture, at least, that the fair rental rate for producers pretty much had to rent at a lower rate than a break even to keep their land base. And that's hopefully changed in this new kind of environment we're in this year now, as of the last couple of years. And of course, government payments made that work in the last couple of years too. So it wasn't a disaster for most producers. But the market rental rate is definitely different than the fair rate. And the market rental rate, it's really hard to get a handle on. So we do have some numbers. If you're in Minnesota, if you go to the Extension webpage and go to the Ag Business Management section, the ABM Extension page, we do have some numbers from FinBin each year that show the average rental rate in each county for at least the state. Of course, that's not up for 2020 yet. It's 2019 data. We also maintain the the USDA NAS average rental rates up there, which are updated. I think they've gone to only updating them every other year. But the average rental rate in the county is helpful. And is, if we watch that from year to year, it's definitely helpful to see what direction rental rates are going. But for an individual piece of land, all these factors that I have listed here, and I certainly don't have all the factors listed that can impact the market rental rate for a piece of land. But every corner of the county is different in terms of land quality. And it's also the competitive market for that land, depending on who's out there looking for land at the time. So it's really hard to say what the right rental rate is for a piece of land. If we're talking about a fair rental rate, that's going to be different from the landlord standpoint than it is from the renter's standpoint. And from the landlord's standpoint, the landlord is trying to earn a certain rate of return on their investment. And so, just looking at that as we might for a piece of land here, we've got a piece of land is valued at $6,000 an acre. The rate of return that this landlord is looking for is a 3% rate of return. So that means an $180 return that landlord is looking for. Plus, he's got to pay real estate tax on that land. He may have some investments in that land. In this case, we just threw in $500 for tiling. That again, he's looking for a 3% return on that investment for another $15. So this landlord is looking for $220 per acre for that piece of land. Would be kind of his minimum that he would be looking for to break even on his investment. The rate, these rates are hard, but of course you think about where you can earn a higher rate than 3%. Certainly not in my savings account. I'm not earning 3%. So, where we used to think of looking for a 5 to 6% rate of return in this current interest rate environment, maybe a 3% rate would be reasonable. And actually, if you look across the board, rental rates as a percent of, you might think about that in your local area, rental rates in your local area compared to the value of the land, you'll probably come out somewhere in that 3% area. It does vary around the country, but that's probably not too far from where you might come out. So it's not too bad a number right now. So that's the landlord side. The renter side is a little bit more complex because what the renter's trying to do is break even on renting that piece of land. And of course, there's a lot more uncertainties involved in that equation than there is for the landlord in terms of what the price is going to be, what the yields are going to be, and all the expenses involved in producing an acre of crop on that land. So the methodology, though, here is to just take the expected gross revenue from that land. Here I'm just looking at simply conventional corn and soybeans with just threw in some prices here. So don't read anything into the prices that I'm using here, but looked in FinBin at some land expenses or non-land expenses, all the non-land expenses. So these expenses I've got here would include all the seed, fertilizer, all the other production expenses plus overhead expenses on that land. And as a renter, I also need to think about earning some sort of a return for myself, for my labor and management that I put into that. So you might think of just thinking about getting $25 an hour for your labor at least, and 5% return on your uh, on your for your managements is 5% against the gross return of that enterprise to come up with a reasonable unpaid if you're not paying yourself out of these expenses, which most people aren't, that unpaid labor and management charge. This, again, I took these numbers out of FinBin, so they're pretty consistent across what we saw last year for corn and soybeans. So that left me with, $160 remaining for rent after non-land costs and $185 on soybeans. If I kind of weight average that against all the acres, I come out with a 50-50 relationship on corn and beans. I came out with a break even of $172.50 for that land. So that's the kind of the standard renter's approach. We're going to talk a little bit about our fair rent tool that that's available to you. And this is exactly the approach that fair rent takes to come up with a break-even rental rate. And if anybody's got any questions or comments, I think what Pauline and Rachel have told me is that we've had a small enough group, so we're not afraid to have you turn on your mics and ask any questions that come up. So anybody who wants to jump in at this point, I'd be happy to try to answer your questions or take your comments.
I had a question. If in using the fair rent tool that you mentioned, like if there is, if it allows for flexibility in entering data for or numbers for specialty crop growers? As opposed to just like commodities or corn and
well,
soy.
you can, yeah, of course. Okay, so specialty crops, yes, by all means, it'll work. It is based on an acre. So sometimes we do struggle with specialty crops where we've got many crops per acre. So you have to work through that issue. The data entry is on a per acre basis. So that would be my concern in terms of specialty crops. Otherwise, you know, I think all the expense chart of accounts items would work for specialty crops. You know, it's going to be a lot more labor intensive, but you can put in your labor costs. Unpaid labor and management per acre will probably be a lot higher for specialty crops. So all those pieces are there. It's just a matter of coming up with the numbers to go into it. Any other questions? And we can talk about that a little bit more when we get there if you want.
What about the irrigated land?
Irrigated land would be the same. It's a matter of coming up with the additional irrigation expenses. The the gross return part of the equation would be the same, but you'd have to capture not only the energy component of the irrigation and any cost of the water, if that's a situation in your area, but and then the overhead costs, the depreciation on the irrigators and those kind of things. So all the techniques, all the approach would be the same. Of course, you know, just like renting organic land, some of that it depends on who pays for what. You know, I was thinking about this in terms of organic land. The rental rate should be quite a bit different depending on who incurred the expenses of converting the land to organic production. So, you know, when we look at the FinBin data, to be honest, we don't see a lot of difference between rental rates on organic land and conventional land. And that may be because the operator has incurred all those costs of the conversion. So same thing with rented land, although I would think the landlord would almost always incur the costs of the irrigation equipment. So that in that case, the renter wouldn't have that cost except for the operating costs, I imagine. So all those things have to be thought through in terms of who's contributing what when you're doing the rental arrangement. So a couple of tools we're going to show you this morning, and then we can talk a little bit more. The first tool I wanted to make everybody aware of is Ag Lease 101, which is a product not of our Center for Farm Financial Management, but it's a product of the North Central Farm Management Extension Committee. So this is cover extension farm management specialists from across the North Central part of the country put this website together. We do manage it at CFFM, but the content is managed by all the extension folks across the region. And I'm going to go to the actual site here. So this is what the actual site looks like. It's aglease101.org, and before I go too far, it's free. Anybody can go in there. There's no cost, no login, no anything to go into Ag Lease 101. And the big thing here is the document library, which is a set of documents that the North Central Committee put together on different leasing topics, which again are some of the most common questions we get. So the most common one, the most basic one here is fixed and flexible cash rental arrangements, which would cover thoughts as you're putting together a standard cash rental arrangement with the landlord, but it also covers putting flexibility into that rental arrangement. So if you want to look at flexing that rental arrangement depending on yield or price changes during the year, you could put that into your arrangement. So there's a publication on share rental, pasture rental, buildings and livestock facilities, equipment leasing, beef cow rental, and then building rental surveys. So there's a lot of information here that has been put together by these groups. And then on the other side here, there's suggested lease forms. So if we want to put together, I'll just jump into a cash lease arrangement here. So this is a fillable PDF for a lease arrangement, which, may or may not all pertain to you, but obviously you could strike out the sections that can pertain. But there's a lot of things in here we don't always think about. Documenting every little thing, payment dates, whether there's any agreement on controlling noxious weeds or anything like that. Lots of things that may be covered in a lease arrangement. And I would say there's no attorneys in this group, so we're not putting this together as a suggested contract. It's just a suggested arrangement where you can take and use it if you want, take parts of it if you want, and use that as your guide. But jump into the cash rental publication here. If we go down and look at the table of contents, there's again the discussion I just went through on looking at it from the landlord and the operator's standpoint. And there's discussion of establishing a rental rate and different ways of doing that. I went through the cash break-evens approach, but there's ways of looking at percent of land value, percent of gross revenue. There's other ways of, dollars per bushel. There's other ways of determining a rental rate that could be used. And then the other big part of this is how to bring flexibility into your cash rental rate. Flexible rental arrangements are, great from the standpoint of the renter, I think, if you can get a landlord to agree to one. The landlords, if they can get a specific cash lease price for their land, and it's not going to vary, they might, if they might be more interested in going with a fixed cash rent. But, especially in situations where you've got that relationship with the landlord, and maybe it's a family relationship or whatever, then putting some flexibility. So it flexes up if prices go up, flexes down if prices go down, or yields, or you can flex on yields, or you can flex on both. So putting some flexibility in that arrangement can be really nice. Some arrangements only flex up. So that's like the bonus type approaches only tend to flex up if things get better. So the landlord gets a little bit more. So as a renter, then you got to be a little careful, because in my mind, you got to start from a little lower base if you're going to only flex up. But it may be in a negotiating approach to be able to get the land, if you tell the landlord that you're going to give him a bonus if the price goes up. So that's another one of those tools that you can use in negotiating. So that's Ag Lease 101. There's it's pretty much all documents, a document library that gives you a lot of background in different lease arrangements. Any questions or comments on that?
One question that you already answered, I'll just, in case folks see it in the chat, it was regarding flex rent arrangements. And I think you talked about some of the high level pieces of that and where to get more information. So. Okay,
good. Okay, well then I'm going to transition over here to fair rent. And see, oh yeah, I've already got it up here, I think. There we go. Okay, so I'll go log out of fair rent. So fair rent, this is the homepage for fair rent. It's fairrent.umn.edu. So again, this is a wide open website. Anybody can use it. We got some grant funds to put this together, which makes it from the North Central Extension Risk Management Education Group. So that makes it available to everyone free of charge. So in this case, we do have a login, but it's just basically so you can control your plans. We're not doing anything with your login information, or there's no cost or anything to it based on your login. It's just a matter of cataloging your rental arrangements under your login. So this is all the plans that I've put together over time. And I just put together an organic cropland 2020 plan here. So we're going to look at that in a second. When you come in here, this will all be blank, and your only option will be to start a new plan right here. And once you start a plan, then you select whether you want to look at cash rent, share rent, or some of the flex rent options. So pretty much the primary flex rent options that are in the Ag Lease 101 publication, we've incorporated into the fair rent analysis. So you can analyze, putting some flexibility into your rental arrangement. So if you do select, for instance, one of these share rent, base rent plus bonus option here, there's some additional questions on this. We're on the plan details page here right now. There's some few extra questions here. Do you want to, what's the base rent? You know, so if we're going to base it at a 200 and then it goes up from there based on a bonus. And also, do you want to put a limit on how much you can go up? And then, of course, the landlord's share. So, you know, do you want to give the landlord, if the price goes up or the yields go up, you want to give that the landlord? Generally, we wouldn't want to give them 100% of that. So maybe split it 50-50 or how you want to split that up. So, and then once you get beyond this page, whether you do a flex or a standard cash rent on the basic crop input page here will not change very much in terms of what you enter. But I go back here, drop back to my plans. This is kind of my navigation tool here. And I'm going to look at this organic cash rent situation that I put together. And so I'm looking at renting some organic land, 70 acres of organic land on a cash rental arrangement in this case. And so I'm going to go to my data entry details. And these are the 3 crops that I've entered here. I can always add another crop down here. But at this point, I've entered organic corn, beans, and alfalfa as the crops I'm going to grow on this land. And what I've done is I've gone into FinBin and I've mined FinBin for the 2020. Sorry, Pauline, I beat our release date here. So this is, we haven't really officially released the 2020 data in FinBin yet, but you're getting a pre-release look at some of the organic numbers that are in the database. And you know, these aren't huge numbers of organic farms, but we do have enough organic farms in our Minnesota database to generate an organic report for each of these crops. So I split it up: 25 acres of corn, 25 of soybeans, and 20 of alfalfa. Last year, just to give you that preview, we averaged on organic land 138 on corn, 32 on beans. These are the average rates, values that were put on that organic land production. In this case, I didn't put any other income in. You know, obviously last year there was a lot of other income because there was a lot of government payments that were received. That we would, you know, if you have government payments on this land that you know you're going to receive, then you would want to include that in your analysis, I assume. You know, as we look forward to 2021, we don't certainly expect to see the amount of government payments next year that we saw last year. But there may be some ARC and PLC payments coming this year. They wouldn't accrue to 2021 necessarily, but they may come. So I guess that would be something you'd have to work out with, you know, in your own mind, because that would actually be accrue to 2020 production. So do you include that or not is another question, or whether you'd actually get that money would be the question in putting together the land rental arrangement. And these are the costs that I found in our database for producing corn, beans, and alfalfa hay last year. So there were some non-chemical expenses that I didn't put under chemicals here. I put them under other direct costs. So there was a little bit of crop protection expenses that I put into other expenses here. When you're putting this together, you kind of have to come up with the numbers down to here from somewhere, from your records, from your knowledge of production costs. When you get down to overhead expenses, I pulled the overhead expenses out of FinBin for our averages. The thing you can do is click on this little icon here. Oh, geez, I didn't expect that. Okay, so we got a little bug going on here. See, how am I going to get rid of that?
I don't know, Dale. Yeah.
I think I'm going to have to doesn't seem to let me off. Don't want to do that. I'm going to have to start over. Sorry about that. One of the rules that I broke here is I didn't click on every possible number, every possible item before I did this. So I'm not going to make the mistake on clicking on that button. That's something we'll have to get fixed. But what that will do is bring up a table where you can put in your farm overheads, go to your Schedule F or whatever, go to your enter your farm overheads for the year, and just kind of allocate those overhead expenses across all the land acres that you have, so you can come up with an average overhead expense for your farm. Now, do I dare click on the next one? Operating interest, I know I did use that detail. So that one did work. So you can, if you don't know what your operating interest was for the year on your cropland, which a lot of times you might be able to just grab your total operating expense for the year and divide it by the number of acres to get that. Or you can do this way, put in your interest rate and then put in how much, what percent of all your inputs you normally borrow and how many months they're going to be outstanding, and let the computer come up with an estimate of your operating interest for the year. And then interest on rent, another operating interest item, which might become a big item, kind of the same thing. What's your interest rate? I did use this one to calculate this, so I just put in 6% borrowing rate, borrowing 50% of my land rent for 10 months. And that's kind of a simultaneous equation. We don't list that expense here on the input, but when it comes to the output, once we know what the rental rate is, then we can calculate that interest on the rent expense. And then labor management charge, like I said, I pulled that out of FinBin, but there is a detailed chart where you can just say, okay, my total farm labor management charge is this amount, and what percent of that is going to land to livestock, and the rest would be divided over my crop acres. So last but not least down here, crop rent or crop insurance information. So we do have in the background here, as we're calculating the break evens, we've got your crop insurance in the background, so that you can, so that as we're looking at break evens across different rental rates and different prices, we can kind of hit that point where it won't get any worse, because crop insurance will cover any further losses. So I'll show you that in the output, I think, as we get looking at the output here. So that is the data entry for a cash rent arrangement. Just calculate the output. This is what it looks like, pretty much a review of those entries we just made. And my break-even rent across 70 acres here would come out to $362 based on those returns. So with all the non-land expenses covered here, we have $362 left to break even on that rental. So, you know, much higher than what we've been seeing on conventional land for sure. But when you think about organic land, there is some logic for that rental rate to be higher because of the cost to convert it to organic, plus generally more intensive management that this has to cover. So, so $362 would be our break even. That's kind of where we would, you know, as a operator, where you would start thinking about, I don't want to, that's my starting point for negotiating with the landlord. If you get into a situation where this is a lot lower, so it's, you know, kind of under the market rate, then you might look at this table down here, because what this is saying is, okay, if we're going to cover everything, that was just $363 right here. If we can't get it from the landlord for that rate, then we've got to start thinking, are we willing to give up some of our returns to get this land? Now, this could, you know, if you're negotiating on a new piece of land, it's not going to be detrimental to your operation. If you don't get this piece of land, you know, then you probably wouldn't look at it this way. But if this is a piece of land that you've been renting and you're trying to figure out a way to keep it, then you might start thinking of, okay, if I can't get it for the break-even rate, then maybe I can give up my unpaid labor and management charge. Maybe I can give up my return to labor and management to keep that land. And the logic there is I'm still covering my overhead costs with that land. So if I lose that land completely, I've still got overhead costs out there that I've got to cover somehow. And so my actual cash position, if I just straight out lose that land and don't replace it, is going to be worse if I just drop that piece of land, you know, and I'm not covering those overheads with something else. So you might think of going down to the point of just covering direct and overhead expenses. And at least you've got that, you know, at least you're keeping that piece of land in your control. Now, if you can't get it for that rental rate, then you got, you know, your absolute last number you probably should be considering would be the $517 here. And I know that's higher than any rental rate that we would see, but in most cases, but that, you know, if you can't get it for the 438, then you at least have to cover your direct expenses. You know, economically, the limit would be, I need to cover my seed fertilizer. I need to cover all my inputs. Why would I rent this land if I don't cover my inputs? So that's kind of the purpose of this table. I wouldn't probably spend too much time looking at the variability of returns. Some of these numbers, sometimes you get so many numbers, it's hard to think through the numbers, but that's what this table is trying to do. And then the next page gives you the sensitivity analysis for looking at what happens if you don't get the yields and prices you planned on. So my break-even rental rate I planned on, let's look at corn here. I planned at 138 bushel corn, 750 organic price. Came out to, for corn, I could pay $450 per acre for that land. But if I only get 117 bushels, then my break even goes down to $295. So lots of variability there that you can look at. And you can see here when we get down to the lowest levels, we stuck at 145 as kind of our lowest here. So crop insurance came in and protected us at that point and said, you know, you're not going to go any lower in your returns, or the break even is not going to go any lower because crop insurance is protecting you at that point. So that's the simple share rental analysis. If we go back, I'll just look quickly. First of all, is there any questions at that point? That's pretty much to digest at that point, I guess.
There isn't any questions, Dale. Just a comment from a little bit earlier when you were talking about organic and irrigated land and some of that, and just a reminder to remember the cost of maintaining the organic certification as one of your fees, which you can include as a direct expense there, depending on who's paying that. So.
Yep. And if you do look at FinBin, you'll see there is a organic fee included in the direct expenses. So, you know, generally hasn't in most cases that I've seen hasn't come out to be a major expense, but it's got to be something that's got to be considered. Anything else from the group? Okay, let's just look real quick at one. I'm going to go back to my plans here. One flex arrangement. So this is a base rent plus, I'm going to look at this one, flexing on yield and price ratio. So this is a one where the rental rate would vary based on the actual yield going up as a percent of the projected yield. So say you're projecting a yield of 180 bushels and the actual yield is 200 bushels, whatever that percent relationship is, the rental rate would flex up or down from that standpoint. So here we've said our base rent, we're going to base off of the 220 rental rate. Maximum or minimum rent, we're not going to flex down below 180. So the landlord's not going to want to go anything lower than that. We could put a max on it, but the landlord wasn't interested in putting a max on it for some reason. So we'll just look at the input here. This is just conventional numbers that I had put together a while back. So it's don't read into this in terms of the prices or yields or anything, because this was put together a while back, basing on 50 bushel soybeans and 180 bushel corn, $9 soybeans and $3.50 corn. So not real low. And again, we stuck with the 50 bushel and 180 in terms of what yields we're going to flex off of. So any actual yields different from those will flex our rental rate that we pay at the end of the year, or any change to the prices. So if we calculate this one, in this case, like I said, back years before, the break-even rental rates were very low. So this is one of those situations where $104 per acre was the what's a break-even for the owner, so or for the renter. So not a great situation. The operator is going to lose $115 per acre on this. So, but you know, like I said, the market isn't break-even. So in this case, the market's 220. If we're going to get this land, we're going to have to base on that rental rate. So in this case, when we get down to the sensitivity analysis, the rental rate is actually the output here. So, you know, what we would normally see here would be you'd set up the base rent of 220, maybe 110 of that would be paid up front. Maybe that's all negotiable, of course. And then we'd wait until the end of the year to figure out what the remaining rental cost would be. And in this case, starting out at 220 as our base for our expected yields and prices, and flexing up if the yields are higher than that, and down if the yields are lower than that. And again, we said 180 is the lowest, so we didn't go any lower than that. And if we look at all crops together, which is probably where you would kind of want to look at, you can see how this would flex up to a maximum of $372 if prices and yields both went up by 30%. And then on the other hand, looking at the operator's side of things, the operator's net profit at those rates. So obviously, if the price goes up, the operator's going to do better, but the price and yields have to go up quite a bit. We're losing money as an operator here up until we get to the highest yields and prices. So again, this was a situation where this person would have to decide whether they were willing to do that or lose the land. So that's, and there's a third page of this, which I think is kind of handy because it just shows you the calculations that are used to arrive at those. So, you know, as we're putting together these arrangements, these are this kind of the simple numbers we're using to calculate. And then an example here, this is hypothetical. So we just threw in the actual yield was this for corn, this for beans, actual price was this for corn and beans. And this would be the calculations to arrive at the final amount of total rent for that piece of land. So, so you could run through that logic in your own mind. So, as I said, putting flexibility in a rental arrangement is, I think it's always something that is useful to consider. But in this current environment, you know, we're seeing a little bit more profit than in the past. You know, it might be something that a landlord would be more interested in now than maybe they would have been a couple of years ago when prices were so low. So it just like share rental arrangements, flex arrangements rely on a lot of your relationship with your landlord has to be pretty good so that they're comfortable with that you're going to be honest with them in terms of the yields and prices. And you want to set up things like how are we going to verify that yield through crop insurance or whatever. There should be a way to verify that yield or actual sales. And how are you going to verify that price? And what date does that price can be measured on? Usually it's, you know, for conventional crops, it's based on a cash market price at a specific location at a specific date in the fall. For organic crops, you know, it would be, again, you know, you wouldn't have a futures market to base it on, but you should have a cash market to base it on, that you could say, this is the place we're going to base this price on, and the date. So that's, I think, a pretty good overview of fair rent, except for the one little difficulty we had there. So we'll have to get in and do some maintenance on that one data entry. But Any discussion on this or any other leasing topic that that comes to mind?
This is Charlie Johnson from Madison, South Dakota.
Yeah, hi.
And I've got a flex arrangement I've used for about the last 10 years with an organic landlord.
Good.
We base it on $150 an acre up front, non-returnable. And then we go into the new year and then we look at the gross revenue of the entire operation.
Okay.
25% of that. And then anything over the 150 is returned back to the landlord the following year in a flex payment.
Okay. Yep. So yeah, you're basing off the whole, you've got the entire landlord's piece of land there and you're basing it off the full operation.
Right, right. Which would include small grain sales, any crop insurance payments, any government payments, any alfalfa sale payments,
Mm-hmm.
corn and soybeans.
Yep. Yeah. Well, and are you and your landlord happy with that?
Yeah, he seems to be real happy with it. You know, it assures him a cash rent payment up front every year, but he also gets to be kind of a cheerleader on the sideline saying, hey, let's get better yields and let's get better prices.
Yeah. And I'm assuming
Also,
that he's a former farmer that's got a pretty good handle on what's going on out there.
Also, he is a landlord that loves to be involved. He actually, and I pay him a going rate for him and the help that he arranges, but he likes to even walk the soybean fields on his own land and take out the hand roguing involved. And so,
yeah. So,
yeah.
now did he convert it to organic, or did you convert it to organic?
He already had it converted to organic, which
Okay.
is a which to me. Yep. Mm-hmm.
Yep. Okay. Good. One comment that I forgot to make here on the organic example I showed you, organic alfalfa. You know, this alfalfa is in full production. So I'm, as a organic producer, I'm leasing established alfalfa here. If I have to establish alfalfa to keep that alfalfa, you know, assuming I'm going from year to year with this piece of land, I'm going to have to add another column here, which is organic alfalfa establishment, or, you know, with a cover crop, or however that's going to be done. So that would definitely, I would assume, lower the break even, because I'm going to incur a pretty heavy cost of seed down of that alfalfa on that. Maybe, you know, in this case, maybe it would only be 5 acres that I'd have to seed down every year, but it will definitely be a lower, you know, in other words, if you can rent organic alfalfa that's established, obviously you're going to have to pay a higher price for that normally than you would if you got to keep reestablishing it, a portion of that every year.
I don't want to dominate the discussion here, but our rotation involves a third of the ground always being in alfalfa. And we go through a 6-year cycle.
Yep.
Top of the cycle is oats as a small grain, or any small grain of your choosing, as a nurse crop. Year 2 and year 3 is 2 years of alfalfa is all. And in year 4, we switch to row crops, which involve soybeans, the 4th year, 5th year, the corn, the 6th year, soybeans, and then we're back to oats as a nurse crop and recycling through alfalfa. So I always like to say it's Monday is oats, Tuesday and Wednesday's alfalfa, soybeans. Friday is corn, and Saturday's back to soybeans, and Sunday is Sabbath. So
So did you say you do fallow it?
no, we should, but it's a 6-year rotation. But
Yeah.
I'm just Sunday's a good year to look at your financials. So
Yeah. Yeah, another thing, that would be another thing that would impact, you'd have to, include fallow in your analysis. So would be another part of the cost of, and any cover crops, all those kind of things are going to be a cost of your production.
definitely.
The person who had the question on specialty crops, did you, after seeing this, did you have any more thoughts on it? Would this work for you? There's no drop down for crops here, so you can enter whatever you want. And maybe that person is gone
No,
now.
sorry, that's me. Yes, this makes sense. Thank you.
Okay. The one thing that adds to the questions is, if you're going to do any further processing of your specialty crops, but that's kind of outside the production realm. So it doesn't seem like that's a major concern in the rental rate. So I don't think any, if you're making jam or anything like that, that's value added that you're producing. So I don't think that impacts the rental analysis. Okay, well, I don't want to prolong this any longer than we have to. Been happy to be with you this morning, and I hope this was useful to you as you think through some of this stuff. We're always happy to answer questions on our products here at Center for Farm Financial Management. So if you have any questions, or be sure to get a hold of us. If I could get back to my, okay. I'm going to try to get back to my PowerPoint here, but yeah. And my email address is on screen right now. So if you have any questions or anything specific to your situation, I'd be happy to visit with you about that. Or refer you on to somebody else who might even have a better idea from out in the field. So, or if anything comes up in the next week before we get together again, I'll let you feel free to ask the instructors next week, which Pauline, I think, will be one. So, Pauline, is there anything else we need to visit about today?
No, I don't think so. I think that took care of all of our questions. Thanks for the discussion, everyone, and the good questions. Like Dale said, reach out and we will email out. I think that's what's been happening, the recording for you to reference for the future as well. So thanks for joining us today, and we'll see you next week to talk about FinBin and Farm Answers.
Thanks, everybody.
Yep, thank you. Have a great day.